Welcome back to the lair, Bat Squad. Pull up a chair and put down the hopium pipe for a second. While the rest of the world is busy high-fiving over the S&P 500 hitting new record highs in early 2026, I've been staring at the plumbing. And let me tell you, the pipes are screaming. You see, the average retail investor is like a moth to a flame. They see a green candle and think it's a stairway to heaven. But you're here because you know that when the party gets this loud, someone is usually about to call the cops. Look at the Shiller P ratio. We are sitting at levels that make 1929 look like a bargain basement sale. We're pushing a 38x multiple, while the Federal Reserve is playing a dangerous game of chicken with sticky inflation. Everyone is obsessed with the Fed's pivot, but let's be real. The Fed's promises are about as reliable as my New Year's resolution to stop eating pizza. They tell you they have a soft landing under control, but history shows that a soft landing is just a slow-motion crash that hasn't hit the pavement yet. We're seeing the Magnificent Seven turn into the Frantic Four. The concentration of wealth in just a handful of AI-driven stocks has reached a point of absurdity. If Jensen Huang sneezes, your entire 401k catches pneumonia. But while you're buying the dip, have you checked what the insiders are doing? In Q4 of 2025 and moving into this month, insider selling has hit a 3-year high. These guys aren't diversifying. They are hitting the emergency exit while telling you the building is fireproof. It's the classic liquidity exit. They need your buy orders to fill their sell orders. Congratulations, Bat Squad. You're being asked to be the cleanup crew for the billionaires. The yield curve, that grumpy old prophet of doom, has been inverted longer than a yoga instructor on a retreat. People say, oh, it doesn't matter anymore. The macro has changed. That's the most expensive sentence in finance. The lag effect is real. We are currently feeling the tremors of interest rate hikes from 18 months ago. Debt servicing costs for U.S. corporations have spiked by 40% year over year. The zombie companies, those that can't even cover their interest payments with operating profit, now make up nearly 20% of the Russell 2000. These are dead men walking, fueled only by the fumes of cheap credit that no longer exists. Let's talk about the invisible thief. You know him as inflation, but in 2026 he's rebranded himself as structural reality. The CPI might show a cooling headline, but look at the services sector. Wages are sticky, energy costs are volatile due to the ongoing geopolitical friction in the Middle East, and the green energy transition is proving to be a lot more expensive than the brochures promised. The BAT playbook doesn't care about what Jerome Powell says in a press conference. It cares about what the bond market is doing. The 10-year Treasury yield is creeping back toward 5%, and that is the gravity of the financial universe. When yields go up, the present value of future earnings goes down. It's simple math, yet the smart money seekers on TikTok seem to think stock prices are exempt from the laws of physics. We are currently seeing a massive divergence between the paper economy, Wall Street, and the pavement economy, Main Street. Credit card delinquencies have surpassed 2008 levels. The average American is tapped out, financing their grocery runs with buy now, pay later schemes. This is what I call the safe trap. People are piling into low volatility ETFs and tech giants because they feel safe. But when everyone crowds into the same exit, the door jams. The liquidity in these safe stocks is a mile wide but an inch deep. In a real deleveraging event, which the data suggests is looming for the second half of 2026, these crowded trades will be the first to blow up. You don't want to be safe with the crowd. You want to be positioned where the crowd isn't looking. Retail sales came in soft last month, yet the market rallied. Why? Because the bad news is good news crowd thinks it will force the Fed to cut rates. That is a loser's game. If the Fed cuts rates because the economy is screaming in pain, that's not a bullish signal. That's an adrenaline shot for a heart attack victim. You don't buy the heart attack, you wait for the recovery. The BAT playbook dictates that we watch the spread between high-yield corporate bonds and treasuries. That spread is starting to widen, signaling that the smart money is getting nervous about defaults. When the credit market starts sweating, the equity market is usually about 2 minutes away from a panic attack.
Now, let's address the elephant in the room: AI. Everyone is acting like we've discovered fire for the second time. And sure, the tech is cool, but from an investment standpoint, we've moved past the innovation phase and straight into the delusion phase. The CapEx being spent by the big players, Microsoft, Google, Meta, is astronomical. We're talking hundreds of billions of dollars, but where is the ROI? 2026 was supposed to be the year of mass monetization. Instead, we're seeing companies struggle to turn cool chatbots into actual bottom-line growth that justifies a 50x forward earnings multiple. History doesn't repeat, but it rhymes. Remember the fiber optic boom of the late 90s? We built the infrastructure, but the companies that built it went bust before the world figured out how to use it. We're seeing a repeat of that infrastructure overhang. NVIDIA's margins are legendary, but they are also a giant target. Competitors are catching up, and more importantly, their customers are starting to realize they bought more compute than they actually need. This is the bullwhip effect in real time. In the BAT playbook, we don't buy the hype, we buy the utility. While the world is chasing the next AI shiny object, the real opportunity is in the unsexy sectors that support it: energy and specialized commodities. You can't run a neural network on vibes and disruption. You need gigawatts of power and tons of copper. The global grid is crumbling under the weight of these data centers. That's where the real smart money is flowing. They are exiting the overvalued software names and entering the hard asset space. Let's look at the dark pools. Large institutional blocks are quietly moving out of the NASDAQ 100. This isn't a flash crash, it's a controlled demolition. They are distributing their shares to you, the Bat Squad, hoping you'll keep the price propped up while they find the door. Don't be their exit liquidity. Look at the volume price divergence. Prices are rising on thinning volume. That's the classic sign of a trend that's running out of oxygen. When the big boys stop buying, the only way left is down.
So, what's the move? Do you sell everything and hide in a bunker with gold bars and canned beans? No, that's for the amateurs. The Bat Squad plays the game better than that. You need to understand the liquidity cycle. We are entering a period of quantitative tightening fatigue. The government is running a deficit of over $2 trillion a year. To fund this, they have to issue a mountain of debt. This sucks liquidity out of the private sector like a vacuum. In this environment, cash is trash is a dead mantra. Cash is actually a call option on lower prices. Having a dry powder reserve of 20 to 30% isn't missing out. It's being the only person with a bucket when it starts raining gold. We are looking for the great reset in valuations. I'm watching for the VIX to spike above 30 and for the fear and greed index to hit extreme fear. That's when the BAT playbook tells us to strike. Focus on companies with fortress balance sheets, those with more cash than debt and a dominant market position that allows them to raise prices without losing customers. This is the pricing power era. If a company can't pass on its costs to the consumer, it's a ticking bomb. We're also looking at international markets that have been left for dead. While the U.S. is trading at all-time highs, some emerging markets in European industrials are trading at single-digit PEs with 5% dividend yields. That's where the value is hiding. The next few months will be a test of your discipline. The media will try to scare you. Then they'll try to make you feel like you're missing the greatest bull market in history. Ignore the noise. Follow the data. Watch the insider to retail ratio. When the people who run the companies start buying back in, that's our signal. Until then, stay skeptical, stay liquid, and remember, in a market full of sheep, it pays to be the bat. We see in the dark while everyone else is blinded by the glare of a fake sun. This isn't just about surviving, it's about thriving when the safe trap finally snaps shut. You've been warned. Now, go look at your portfolio and ask yourself, am I holding this because I believe in it or because I'm afraid to let go? The answer to that question will determine your net worth by the end of 2026. Stay sharp, Bat Squad.